In today's real estate market, there are tremendous opportunities for those who invest wisely. And one of the wisest ways to get into the market is by joining a syndicate or group investment. Why? Smart investors limit their exposure by pooling assets for specific properties or projects, letting them participate in much larger deals with higher returns. And it all starts with the promoter. It's the promoter's job to seek out group investment opportunities. Once he's performed his due diligence on a property or project, he then sets about to form a syndicate or small group of investors. So, how does it work? The promoter identifies a property with the potential for achieving a high rate of return for investors. When an investment opportunity is selected, the promoter ties the property up with a deposit and contract, effectively taking it off the market while he or she performs due diligence. As part of the due diligence, the promoter makes a careful inspection of the property. Concurrently, he must make sure he has the support of investors to fund the purchase. If the property passes necessary inspections and meets other requirements, the promoter engages securities attorneys to produce the investment documents. These documents include the private placement, the operating agreement, and subscription agreement. The attorneys will then set up an LLC to accept investors' capital and acquire the real estate. As an LLC, shares of stocks are made available for investors to purchase. At this point, the process of fundraising begins as the promoter goes back to his or her investors with marketing material and a proposal to formally participate in the transaction. Each investor buys as many shares of the transaction as they want, subject to minimum or maximum purchase amount imposed by the promoter. Some promoters impose a restriction on the total number of shares that any one investor can buy, so they can manage voting rights and control the transaction more effectively. This not only protects the promoter, but it also protects other minority shareholders from any single dominant shareholder taking over the transaction in a way that will be unfavorable to the rest of the investors. Of course, the promoter might put in a little bit of cash too, but this is generally very little compared to what he will take out of the deal in exchange for management and other services. When the shareholders are set, the group or syndicate then chooses a president for the new company, LLC. This can happen through shareholder voting. However, as is often the case, the selection of the president is actually contained in the legal documents. The next order of business is to hire a broker to manage the acquisition of whatever real estate the company is going to buy. In some cases, the promoter himself works as the real estate broker and may even hire himself for other services for which he is qualified. And that's how you turn real estate into shares and profit. If you are interested in becoming a promoter or finding out about group investment opportunities in real estate, visit www.InvestorValet.com.